I am going to warn you that um, this is going to be a bearish market chat, and I don't like that very much. All of you know me and know that I really don't like the bearish case at all. But today, I don't think we can ignore it. So I'm going to hit record and try to keep everybody on mute as people join late, and let's just jump right into it. All right. Hey, good morning, everybody, and welcome to Market Chat. It is Wednesday. It is time to review what's happened in the market. And actually, this week we have a lot that's occurred. So we've had a lot of noise in the marketplace with the equities and the coronavirus and oil and all that stuff. So let's try to get some clarity from what's happening and be objective and simplify what we're doing so that we don't have to spend a lot of time worrying about it. All right, we're going to dive deep into ethanol here in just a little bit. But let's go through the major headlines that are in the market. First of all, we all know there's extreme volatility in the equity markets. Um, um, Volatility like we haven't seen since 2008. And there's just a lot of talk about a global slowdown, right? A lot of projects that were in the works for capital expenditures are being halted and delayed. So a lot of the big companies' outlooks are just extending forward. So what was going to be in Q2 of 2020 is now going to be in Q2 of 2021. So there's just a lot um, of moving going around in these big companies as they try to protect their equity. Now, the biggest one we're going to talk about today is oil. Oil reset itself 25% on Sunday night, and that's because Saudi Arabia waged a price war with Russia. And if there's anything I think we need to focus on there is that when you read and analyze when countries make statements economically like Saudi Arabia did. So for those of you that don't know the background, right, Russia and Saudi Arabia have been cooperating with oil production output in order to maintain high prices. Russia came out and said, we're no longer going to cooperate and we don't agree with you. So Saudi Arabia said, all right, we're going to unload all of our demand, all of our supply on you, and we're going to drown you out in oil. So what history tells us is that when countries make statements like that, they make that statement with a long-term perspective, not a short-term perspective. Think about the trade war with China. When President Trump slapped tariffs on China, the market wanted an immediate negotiation and resolution to that deal. It still has not happened, right? We're 2 years into it. President Trump went into that with a long time horizon, not a short time horizon. So I think you have to assume that Saudi Arabia is looking at the long term, not the short term. Now, China, will they buy? You know, that's still out there. The dollar is cheaper than it was, which should help our exports. And, you know, there is talk of high moisture and weather stuff about can we get into our fields for it or not. Let's dive a little deeper into ethanol, though, because here's the reality. The reality is corn economics are not fantastic. I think I have a slide on this later. Yeah, so jump to here. So the corn economics are not overwhelmingly great at the moment anyway. The U.S. is already starting with a 2.5 billion bushel carryout. That means that we had 1.892 billion bushels left over from last year. We're going to grow a record crop this year and plant it. And all of you guys know this as producers. We don't have a choice but to grow the bushels, right? You cannot replace the bushels, so we got to grow them. Reducing supply and keeping the planters in the shed is not a viable option for any of us, so we're going to grow them. And the crop we expect to grow off the acreage we expect to plant is massive. So we're looking at the U.S. corn carryout swelling to 2.5 billion bushels. Now, on top of that, the South American crop is looking to be a record. The issue we had Sunday night with oil collapsing 25% is that it makes ethanol economically unviable. So the question we have to be asking ourselves is, how cheap does corn have to be to keep ethanol alive at $30 oil? Now, let's put that into perspective about what that means for corn, right? Why does corn care about ethanol? Well, it's because it uses 5.5 billion bushels of corn every year in the ethanol industry. It's by far our biggest customer. So a slowdown or hiccup in ethanol production is catastrophic for corn because it just goes directly to our carryout. Now, Saudi Arabia and Russia, they can try to drown themselves out all they want. We got a strong oil industry, right? We're fine. That's not true. If you've paid attention to the oil stocks, they've been hit harder than anybody else. So let's talk about why that is. The U.S. is the highest cost producer among the major oil producing countries. Our oil's deeper. Our oil is harder to extract, which means our lifting cost is much higher than anybody else's. And so, plus we have pipeline issues. We have some logistical issues in bringing it to market. Think about the Alaska pipeline. Think about the pipeline trying to come in from the shale in North Dakota, right? We have political opposition to pipelines, so that slows the transport and raises the cost. So our oil companies have been borrowing money for the last 5 years in order to subsidize. They've been taking advantage of cheap interest rates, and they've been borrowing money to pay dividends, because even at $50 oil, they aren't in great shape. At $30 oil, they're done. They're bankrupt. They cannot sustain it because their lifting cost is significantly above that. So if the oil industry is going to cut back on production, that means that there's less ethanol needed. And that's not going to support our prices if Saudi Arabia and Russia are flooding the global market, right? So all of that implies that ethanol demand is down. And even the ethanol that we have is being made at a loss. So the current economics today of ethanol are negative 25 cents per gallon off the crush margins. So that means you buy spot corn, you sell spot ethanol, you sell spot DDGs and spot oil, and your net loss is 25 cents a gallon before overhead. That's before debt service, that's before overhead, that's before everything else. So what happens in these markets when things like this happen? Let's think back to last summer when the planting delays happened, right? So we were expecting a big carryout, and all of a sudden the weather shifted and we got this huge supply shock, right? So the market immediately reacted and said, we cannot afford for the corn carryout to be collapsed from 2 billion to 0 because we didn't plant 45 million acres of it. That cannot occur. So the market immediately pushed itself up to a value that encouraged the farmers that previously couldn't plant to drag their planters out of the shed and plow and put it in the mud, right? And get that crop planted. And now the last year we've dealt with the reality of the fact that we can grow corn in mud, and now we have a big supply again, right? So the market did that through price action by encouraging supply. It fixed the glitch. Now, what does that mean in reverse here? We don't have a supply shock, we have a demand shock. So in order for, think about it, if ethanol plants stop grinding corn, on a 10% reduction, that's a 500 million bushel increase in our corn carryout. So we no longer are talking about a 2.5 billion bushel corn carryout, we're talking about a 3. But what if it's worse than that and $30 oil persists for 120, 180 days? Now all of a sudden you're talking about 50% of the ethanol production shutting down, which is almost 3 billion bushels of corn that's not going to be ground. Now your carryout is 5.5. So corn has a very significant role to play in this ethanol debacle that's now 72 hours old. And I don't think we've addressed it yet. We got to really digest it and ask that question: what price does corn need to be in order to make sure the ethanol industry is viable enough to grind it? So, how cheap does it need to be? The math that I'm doing is very bad. I think it needs to be between 275 and 3 in order for ethanol to continue to grind it. Now, maybe we'll get a quick resolution and oil will snap back to 60. And that's what it's going to take in order for ethanol to be competitive. And this is why you're reading all this stuff on the RFS, you're reading all this stuff on waivers, and you're hearing stories about the ethanol industry lobbying, the oil industry lobbying the White House to say, we're in trouble. You can't force us to blend ethanol because we don't need it. That's what they're saying, and they've been saying it for a while. So now I know that's extremely bearish, but let's look at the charts too, because they're not giving us any warm fuzzies either. So here's soybeans, right? I'm going to start there. Soybeans, last week we wrote, beans pencil less poorly than corn, so beans need to reset because that doesn't want the acres. So they did. They've reset. Beans are struggling with this gap that's open here from Sunday night, and it may get filled, but make no mistake, the downtrend here is in full force and effect, especially if we take out Monday's low, and beans can work lower from here. Yes, we have a divergence on the MACD, but this is no longer a divergence on the force index. So that signal we talked about here has invalidated, and this is now pointing more towards a sustained downtrend in beans. And y'all know me well enough to know I hope to all glory in heaven that we're wrong on this analysis. I truly do, because it's catastrophic and it's a perfect storm. Now, corn, we've been talking about this for months, that a break below this bottom wedge line counts at least 45 cents. And it counts 45 cents from the break. We've had 2 breaks below it. Today could be day number 3. Each successive break would increase the likelihood of a deeper, more sustainable break in that price. What could cause that to happen? Well, clearly the ethanol industry imploding would do that. Now, let me back up just a little bit. I know that was extremely dramatic what I just went through, and I did it a little bit on purpose, and I did it because I'm not reading anybody talking about that. There's not one of the analysts that I read that has waved the red flag and said, "Oh crap, this ethanol deal, this oil deal is terrible." In fact, what they're telling us is, doesn't matter, we have the RFS. Well, until we don't. There's, the argument is that if we're not going to burn the gasoline, we don't need it anymore. So the RFS is not in great shape. And if you read Grassley's comments, he's implying the same things. So a break below this level implies a much lower corn price than what we currently have. So what do? Hedge, hedge, hedge. Hedges have got to be in place here. In my view, if there's ever been a time to risk a nickel or a dime on downside protection, this would be it, because there is a black swan event out there that could cause corn to reset value if it decides that it has to sacrifice itself to help ethanol, right? So hedge your corn. The downside risk is there. Do not convince yourself it cannot go down. Do not convince yourself that it has to go up, because it does not have to do anything for us. So be very careful here. Now, a move back above 388 would tell us that something different has happened, and we'd want to be looking bullish. But below 388, 390, we want to be trading the bearish side of this market, because in order for a sustained rally to happen, we have to have something that would contract the carryout. And what could that be? Well, lower supply or more demand. And today, what is that going to be? I mean, the planting delay is not going to be bullish if it's too wet, because we know how that turned out last year. The China might step in and buy 1 billion bushels of corn, which nobody's suggesting that they will. They might step in and do that, but all that does is take us back to where we are on our carryout. That does not lower it from current economics. So it may give us some short-term lift, but I think that's a rally that's got to be sold and not necessarily bought. So be careful that that could really deteriorate for us. All right, wheat. Wheat's been in a down move. Nothing's changed on that. Nothing down here is suggesting that wheat's about to tear higher. The U.S. dollar is significantly lower than it has been, but so far that hasn't translated into a bullish bias. So, all right, that is all I've got today. Now, I desperately hope that analysis is dead wrong, and that we are and that Saudi Arabia turns the spigots off and oil goes right back to 60, and we're all good. I really truly hope that, but I think we got to get our heads around this new reality that ethanol does not compete with $30 oil, and it's not a viable substitute to gasoline at that prices, because the cost to produce it is too high. So that is all I have for you today. Please call me, challenge that ethanol number. Tell me we're wrong, because I'd love to be. Have a great week, everybody.